All right, let's dive into one of the most talked about IPOs in a long time, Tata Capital. The big question really is simple. Is all this hype justified, or is there something else going on under the surface? We're about to find out.
You've probably heard this one, right? Maybe in the family WhatsApp group. Hey, it's a Tata company. Dad says just buy it, don't even think about it. When a name as trusted as Tata comes along, that temptation to just jump right in is, well, it's really strong.
But hang on a second. Is a famous last name really enough to guarantee a great investment? Today, we are going to peel back the layers on this IPO. We're going to do the homework that separates the smart money from, just following the crowd.
Okay, so first things first. Let's get the basics down. What exactly is Tata Capital, and what is this IPO really all about? So at its core, Tata Capital is an NBFC. That stands for non-banking financial company. Now, in simple terms, you can think of it like a bank. It gives out loans, it offers financial services, but it just doesn't have a full-on banking license.
So how big of a deal is this company? Well, it's the Tata Group's flagship in this entire space, and it's the third largest NBFC in all of India. Get this. They're managing a loan book of 2.33 lakh crore. That's a huge number, and they do it all through a network of 156 branches. This is a very serious player. And the IPO itself? The scale is just massive. We're talking about an issue size of 15,500 crore rupees. A number that big is exactly why this thing is grabbing so many headlines.
Now, if you're thinking about investing, here are the numbers you need to know. The price band is set between 303 and 326 rupees per share. That's the range where you'll be able to place your bids.
Now check this out. A whopping 97% of their income, it comes from one thing: lending. This isn't some super diversified company with a dozen different businesses. Nope, it's all about loans. Plain and simple. Okay, now that we've got the basics covered, let's get to the exciting part, the bull case. Why are so many investors practically lining up for this IPO? Let's dig into the company's biggest strengths. Wow, this slide right here tells a really powerful story. Just look at that growth. Over the last 2 years, their revenue has been growing at a rate of 44% a year. Their assets growing at 35% a year. Those are some incredibly strong numbers, and they show a business that is expanding and fast. And hey, if that wasn't impressive enough for you, how about this? A 120% jump in profits in just the first quarter of this fiscal year. I mean, that kind of explosive short-term growth is exactly what gets investors' attention. It's a huge, huge green flag. And the good news just keeps on coming. Tata Capital is a top-tier NBFC. It's got a solid AA credit rating, which basically means it's financially stable. Their net interest margin, that's the money they make on loans, is a really healthy and stable 5.1%. Plus, 98% of their loans are under 8 crore rupees, which is a great sign. It means they aren't overly exposed to one single massive borrower going bust. So yeah, the bull case is strong. You've got amazing growth, a trusted brand, rock-solid financials. But look, a smart investor always looks at both sides of the coin. So now, it's time for a reality check. Because, underneath that shiny surface of those incredible growth numbers, there are a few red flags, and you absolutely need to know about them before you make any decisions. So red flag number 1 is debt. For every single rupee of its own money, Tata Capital has gone out and borrowed 6.5 rupees. Now that's a lot of leverage. And while borrowing can definitely fuel growth, it also seriously ramps up the risk if the economy suddenly takes a nosedive. And all that debt brings us to our next point, bad loans. See, the company's credit cost has actually crept up from 2.1% to 2.4%. What that means in simple terms is that more of their loans are going bad. And if that trend continues, it could start to eat into those amazing profits we were just talking about. So how do they stack up against their rivals? Well, at 1.9%, their bad loans are actually a little bit higher than a big competitor like Bajaj Finance. And while they are doing better than others like Shriman and Chola, it shows they aren't exactly best in class when it comes to this really important metric. Okay, we've looked at the good and the bad of the business itself. Now let's talk about the price tag. Is this IPO a good deal, or are you maybe paying a little extra for that famous Tata name? Let's break down the valuation. The price-to-earnings ratio, or PE, is about 37.8. That's pretty much in line with the rest of the sector. No big surprise there. But the price-to-book value ratio, the PBV,
That's a different story. At 4.1 times, it's actually higher than the sector average. That means you're being asked to pay a premium for the company's assets.
So where does that leave us? We've seen the fantastic growth and the power of the brand, but we've also uncovered some red flags around debt and the valuation. Let's try to bring it all together.
Honestly, this quote pretty much sums it all up. Tata Capital is a strong business with incredible growth. No doubt about it. It's a powerhouse in the market. But those concerns about high debt, rising bad loans, and that premium price tag, they're also very, very real. And that brings us right back to our main point, doesn't it? Investing based on hype is a gamble. The real power, the real edge, comes from understanding both the incredible potential and the hidden pitfalls. So we've laid out the bull case and we've pointed out the red flags. We've looked at the numbers and we've looked at the story. The final call, well, that's up to you. Now that you've done the homework, what's your decision going to be?